Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello friends, this is Vijay Bhambwani here, and in this video I want to talk to you about a critical update of interest rates versus inflation. For those of my viewers who've been watching my videos for a fairly long time, you would recollect many of my videos about sovereign investments, sovereign bonds, 100% guaranteed government investment avenues, and the RBI Retail Direct GSEC portal, wherein you can deploy money in 100% RBI government guaranteed investments and at rates that are yielding somewhat better yields than a bank fixed deposits. Now, I have been talking about why interest rates need to rise because A, inflation is going up, and up to last year, $19 trillion was invested in sovereign bonds that was yielding zero or negative returns. Now that amount has come down by more than 50% and money is seeking higher rates of interest. So to tame inflation, many central banks around the world are raising rates, but very recently, our own finance ministry has announced a cut in the Employee Provident Fund EPFO interest rates from 8.5% per annum to 8.1% per annum. This is approximately 4-decade low yield on this instrument. So what's really happening? Should you actually lock in rates in government guaranteed schemes, or do you think this is a one-off event wherein it won't actually spread to other investment avenues? I'm talking purely of sovereign guaranteed. You see, I am personally a votary of investing in sovereign guaranteed schemes vis-a-vis private sector fixed income instruments. There is a massive difference in sovereign guaranteed schemes and private instruments. The most obvious is, of course, that a sovereign guaranteed scheme is backed by the government and therefore there is almost zero probability of default. On the other hand, we've seen how a couple of debt schemes have gone belly up from the private sector, and the other aspect, a differentiating aspect as far as I'm concerned, is that there is only one entity in the financial markets here which has the authority to print currency, which is the government. Now, if at all there is a push coming to shove kind of a scenario, the government can always churn out money from the printing presses. Of course, the buying power will erode, but hey, at least there'll be some return of capital so that you can at least get your money back. So there is always a higher degree of comfort in sovereign investments. So now, as the finance ministry said, that they are cutting down interest rates from 8.5 to 8.1% for the EPFO because they want to rationalize the yields. To be fair and to be honest, yes, this yield is far above the bank FD rates and the sovereign bonds that are 10-year benchmark bonds that are yielding close to 6.8, 6.9%. So 8.1% is higher. Let's not forget that by cutting down interest rates on sovereign investments, the government itself is cutting down its own cost. Interest is a cost payable by the government, and by reducing that interest, they are reducing their own cost. So it's undeniable that in these times when other instruments are fetching far lower returns, chances are that the rate cut once the financial year is done, which is 31st March 2022, chances are that other avenues in the sovereign investment space might also start to, like it was talked about, the EPFO rationalize. Chances are the other investment avenues may also rationalize interest rates. So should you lock in rates? Should you actually divert money from elsewhere and lock in your rates in, say, a post office TD, which is term deposit, or MIS, monthly income scheme, senior citizen scheme, or buy 10-year benchmark bonds, or maybe Kisan Vikas Patra or any such other sovereign investment schemes? The answer is extremely difficult. So I'm going to answer this question in the only way I know how to. What am I doing? I'm basically locking in the rates to the extent of at least 25 to 30% of my allocation that I had made for FY 2022-23. I'm going to lock in that money in the month of March itself to the extent of 25-30%. I don't want to wait till the next financial year starting from 1st April and be confronted with the possibility of lower rates. I'm taking my chances that the remaining 2/3 will be deployed come 1st April or later. So should you lock in? Yes, I think you should lock in, because there are so many uncertainties in the calendar year 2022 that the headwinds faced by the higher risk asset class, which is equity, seems to be absolutely elevated as compared to what you saw in 2020 and 2021. The comfort with fixed income instruments is that, number one, you avoid any kind of capital depreciation that would come should the stock market fall. Number two, you are also gaining 5, 6, 7, 8, 9% wherever you've deployed your money, which puts you at a significant advantage to your next door neighbor whose portfolio is down by 30% in the stock market. So asset allocation is a must. You must spread your money across asset classes so as to avoid the unpleasantness of a risk of a price meltdown. So friends, should you actually take a call and lock in rates? I told you at least about 1/3 of my money I'm going to lock in the month of March itself. How you do it? It's your call. Depending on your risk appetite, depending on your age profile, depending on your personal preferences, I would suggest you lock in at least some. On this cheerful note, I bid goodbye to you, not before reminding you to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. Good, bad or ugly, I always welcome your comments in the comment section. And help me reach out to fellow like-minded investors and traders by referring my videos to your family and friends. Thank you for your patience till we meet again in my next. This is Vijay Bhambwani signing off for now. Take care. Bye-bye.